So you want to own an offshore oil rig. 400 feet above the dark, angry waters of the North Sea sits 40,000 tons of steel, concrete, and high-pressure hydraulic pumps. To the uninitiated, it looks like an iron island, a literal floating license to print money anchored directly over liquid gold. You imagine pulling millions of barrels of crude out of the seabed, selling them at benchmark spot prices, and watching an endless river of cash flood into your corporate bank accounts. It sounds like the ultimate industrial monopoly. It isn't. The moment you buy an offshore oil rig, you discover a brutal, counterintuitive truth. You are not actually in the business of selling oil. You are in the business of surviving a daily financial, operational, and structural nightmare where every tick of the clock burns tens of thousands of dollars, whether you are pumping oil or sitting completely idle. You do not own a passive wealth engine. You own a hyper-complex, capital-devouring floating factory that operates in the most hostile environment on Earth, where a single mechanical failure, a microfracture in a steel riser, or a shift in global spot pricing can vaporize a multi-million-dollar balance sheet overnight. Welcome to the world's most terrifying high-stakes casino. Entry into offshore oil extraction is locked behind a financial wall designed to filter out anyone who isn't a sovereign state, a multinational energy conglomerate, or an extremely aggressive institutional private equity consortium. At the lowest rung of the ladder, you have shallow water jackup rigs. These are self-elevating platforms with 3 or 4 massive lattice legs that lower down to rest directly on the ocean floor, lifting the hull completely out of the water. They operate in water depths up to 350 feet. To acquire a working, second-hand jackup rig, your buy-in starts at $40 million. If you want a brand new, modern, high-specification jackup fresh out of a Singapore shipyard, the price tag jumps to $200 million. Step up to the mid-market tier, and you enter the world of semi-submersible rigs. These are floating structures supported by massive submerged pontoons that fill with water ballast, submerging the hull below the wave zone to maintain structural stability in brutal 30-foot ocean swells. Designed for deepwater operations down to 3,000 feet, a reliable semi-submersible requires an upfront capital commitment between $300 million and $500 million. At the absolute peak of the industry sit the ultra-deepwater drillships. These are massive self-propelled vessels equipped with dynamic positioning systems, satellite tracking, and computer-controlled thrusters capable of holding a 60,000-ton ship precisely over a wellhead 12,000 feet below the surface in roaring Atlantic gales. A single ultra-deepwater drillship costs between $700 million and $1 billion to build from scratch. And that is just to buy the physical vessel. Before you drop a single drill bit into the seabed, your capital structure is already bleeding heavily from financing debt, insurance premiums, and specialized shipyard mobilization fees. To understand how an oil rig actually makes money, you have to throw away everything you know about normal business operations. Oil rig owners rarely drill for their own account. Instead, the primary economic engine of the offshore industry revolves around the day rate model. You lease the physical vessel, the specialized technical crew, and the drilling apparatus to integrated oil majors like Shell, BP, ExxonMobil, or Chevron under strict, short to medium-term service contracts. Your top-line revenue is defined by a single metric, the day rate. In a roaring bull market, when global crude oil prices breach $80 a barrel, an ultra-deepwater drillship can command day rates of $450,000 to $600,000 per day. In a depressed market, those rates collapse below $200,000 per day, often dipping beneath the baseline operational threshold required just to service your capital costs. This brings us to the core operational metric that dictates whether your rig survives: operational efficiency, better known in the industry as uptime percentage. If your rig experiences an unplanned shutdown known in the field as downtime because a top drive motor burns out, a mud pump valve blows a seal, or an offshore supply vessel collides with a mooring line, the contract clock stops immediately. You do not get paid a single cent for any hour the drill bit isn't rotating or performing active operations. Yet, your operational expenditures, crew wages, helicopter transport, diesel fuel, maintenance, caterers, and insurance continue to burn at a flat rate of $150,000 to $250,000 every single 24-hour cycle. This reveals the central paradox of offshore energy economics. Your profitability is completely decoupled from the market value of the oil you are extracting. but fully bound to the total uptime reliability of your machinery under extreme pressure. The physical layout of an offshore oil rig is not designed for human comfort or structural aesthetics. Every square foot of steel is a cold, calculated psychological and spatial trap engineered to manage extreme pressure, contain explosive volatiles, and maximize operational throughput within a tiny spatial footprint. At the center of the platform rises the dayrate, a steel framework tower designed to lift and manipulate miles of heavy steel drill pipe weighing hundreds of thousands of pounds. Beneath the main deck sits the mud pit floor and shale shakers, a loud, foul-smelling zone where synthetic drilling fluid, affectionately called mud, is continuously pumped thousands of feet down the drill pipe to cool the diamond-tipped bit, lubricate the hole, and bring rock cuttings back to the surface. Then there is the structural liability that keeps rig owners awake at night, the blowout preventer, or BOP. Sitting directly on the seabed thousands of feet below the rig, the BOP is a multi-story, 500-ton stack of high-pressure hydraulic rams and shear valves designed as the absolute last line of defense against subsea catastrophes. Its sole job is to seal the wellhead or physically slice through thick steel casing if high-pressure natural gas or oil rushes up the drill pipe uncontrollably. The hidden liability lies in the maintenance of this deepwater monolith. A single malfunctioning hydraulic solenoid or leaky seal on a subsea BOP requires pulling the entire miles-long riser pipe back up to the surface piece by piece, a grueling process known as tripping, which can freeze active drilling operations for 5 to 10 days straight. At a day rate of $500,000, a single microscopic rubber seal, failing under 10,000 pounds per square inch of subsea pressure, can instantly cost a rig owner $5 million in lost revenue and emergency technical intervention. Beneath the impressive top-line revenue metrics lies a brutal structural flaw: extreme cyclical volatility combined with massive, fixed capital drag. When global oil prices drop, energy majors immediately slash their capital expenditure budgets. They cancel offshore exploration contracts, freeze drilling programs, and leave rig owners stranded with hundreds of millions of dollars in debt on assets that have nowhere to go. When a rig loses its contract, the owner faces a terrible financial decision: keep the rig in warm stacking or force it into cold stacking. Warm stacking keeps the rig operational, moored near a coastline with a skeleton crew on board, running generators and maintaining basic machinery so it can be deployed within 30 to 60 days. This costs roughly $20,000 to $40,000 per day in pure loss. Cold stacking means turning off all systems, dismissing the entire specialized crew, coating all critical machinery in protective rust-inhibiting grease, and dropping anchor in a bay. Cold stacking cuts daily holding costs down to a few $1,000s, but it inflicts severe long-term damage on the asset. Mechanical systems degrade, electronics rot in ocean humidity, and bringing a cold-stacked drillship back to life requires a mobilization overhaul costing anywhere from $20 to $50 million. Consider the historical case of Ocean Rig UDW. Flush with cheap, high-yield debt during the commodity boom of the early 2010s, Ocean Rig built an elite fleet of state-of-the-art, ultra-deepwater drillships. When crude oil prices plummeted from over $100 down to $30 a barrel in 2014, global day rates collapsed. Deepwater exploration ground to a complete halt. Ocean Rig found itself carrying over $3 billion in debt, while its brand-new $600 million drillships sat cold-stacked in Norwegian fjords, earning zero income. Incapable of servicing its massive fixed interest payments against non-performing capital assets, the company was forced to file for Chapter 15, bankruptcy restructuring, wiping out equity investors and selling its assets at deeply discounted valuations. A second case of structural failure was demonstrated by Transocean during the aftermath of the Deepwater Horizon blowout in 2010. While BP was the field operator, Transocean was the owner and operator of the semi-submersible drilling rig itself. The catastrophic failure of the subsea well control system resulted in the loss of the vessel, massive environmental liability, endless regulatory freezes, and years of litigation. The incident fundamentally changed the regulatory framework for offshore operations globally, imposing strict safety protocols, expensive secondary shear ram mandates, and soaring insurance premiums that permanently elevated the baseline operational expense floor for every offshore operator on Earth. To survive as an offshore oil rig owner, you must master a business model where long-term capital preservation is constantly threatened by violent commodity cycles, brutal environmental friction, and incredible financial leverage. The math of an offshore rig reduces to a cold conceptual equation. Net revenue equals contracted day rate times active uptime percentage. 2. Fixed debt service, plus daily OPEX, plus amortized maintenance CapEx, plus stacking reserve provision. In peak market conditions with a 98% uptime record, a well-managed ultra-deepwater vessel can net operational margins between 25 and 35%. But over a full 15-year asset cycle, after accounting for market down cycles, cold stacking periods, dry dock overhauls, and debt refinancing costs, the true annualized net margin for an offshore rig operator hovers between 4 and 8%. The global energy transition and modern offshore drilling sector are dominated not by romantic oilmen or heroic engineers, but by massive, disciplined fleet consolidators like Transocean, Valaris, and Noble Corporation. These institutions operate as cold, cynical portfolio managers, constantly balancing high-risk long-term charter contracts against complex debt structures, scuttling old iron for scrap metal the moment market rates dip, and riding out commodity winters on balance sheet scale. The lesson of the offshore oil rig is absolute. The ocean does not care about your financial projections, and the market does not care about your sunk costs. The system is built to reward the disciplined institutional debt managers and capital allocators who control the contracts, never the over-leveraged amateur seduced by the illusion of floating oil wealth.